All right, Yield Nerds, episode 189. The shock and awe in the market is on. It is melting 6-7% declines for the last month. And I'll tell you how I have traded during this crisis as I perfectly balance the bull and the bear in front of the New York Stock Exchange. 490 something subscribers. Thank you for your support. If you're new to the show, please use the Income Investing Roadmap. We have a few other playlists as well. And most importantly, don't take my word for anything. Make sure you do your own data checking. Well, speaking of checking, we'll check on the market temperature. The bull definitely seems to have the upper hand, although I am fighting back. And I'll tell you how my portfolio is doing compared to the market. And then I'm going to develop three scenarios for an upcoming Warsh chairmanship of the Fed. And I'll tell you what those three scenarios are, how I'm informing myself, and what trades I'm making based on those three scenarios and their likelihoods. And I'll share my trades as well. Well, in a year, I have almost quadrupled and then some my equity holdings, and that hasn't been incident free. You can see that a month ago, I was living it up, absolutely destroying the NASDAQ and the Russell. And you can see right about here that I am crashing along with the market. I'm still ahead, healthily ahead of the market, but my equity portfolio has indeed seen that downturn. And you may know, the folks who watch this may know that I use an algorithm to chase momentum to buy. Well, if you keep chasing momentum and the momentum comes down, you also need to sell. And I did not sell. I hung on to it tight and I paid the price. And so I am trying to go faster and smarter ahead of the market, and I'll tell you what I'm doing. Now in bonds, I have a very interesting play there. You may have seen in the previous screen that I'm more like 88% bonds, so that pretty much controls my overall portfolio. The Bloomberg US Credit Index was head and shoulders above me a month ago, and look at what happened. Woohoo! If you followed Bloomberg Credit instead of Yield Nerd Credit, if you will, then you had the world handed out to you really raw. My portfolio went from 0.98% gains to 0.78% gains, while Bloomberg US Credit went from positive 1.26 to negative 0.57. Ouch. So a lot of stuff happening in the world. Now let me get to the subject matter here. What are the three scenarios when Warsh comes in? And so I kind of developed this with a lot of research. And before I share more of it, I want you to know I am not a wealth management advisor. This is not investment advice. I am sharing my education and I learned from your comments as well. So please share. Well, the first scenario obviously is that Warsh comes in and waves a magic wand and succeeds. Well, what does success mean to Warsh? Warsh said, hey, you know what? We're not going to support long bonds. We're just going to let the market set the price for long bonds. And if the market needs more of a discount to hold long bonds, and that means the yields are higher, too bad, so sad. That is what Warsh would say. Now, where he does want to focus a lot of his energy is on the short end of the curve. And he says he wants to reduce short-term rates. And that is because he believes AI is here. AI will heal everybody. It's going to give these tremendous efficiencies, and America needs to capitalize on it. And this Congress, they are spending a lot of money. We'll just tell Congress, you know what? If you want to decrease the amount of debt service, you figure out how to decrease debt. I am not going to do it for you. Good luck. That is what Warsh would say, or at least that is what Warsh has promised to say. And so if Warsh is wildly successful, that is what would happen. So scenario one, Warsh walks in and knocks short-term rates by 1%. Nice job, Warsh. Everybody goes in with him. They all vote. The Fed says, yep, we'll do the 2.5%. The market, however, is not ready to accept the current 4.2% that's there on the Treasury. The market wants 5 to 5.5% long-term. Inflation comes down because AI has waved the magic wand. Employment is up. It has created all of these jobs. GDP is roaring. Equities are booming. America spends less money and we make more because our GDP is higher. That is the magical scenario one. Let's go to scenario two. As I bench press and power lift the gold and the dollar bills there, I'm looking pretty good there. Scenario two, however, is what we would call stagflation. In stagflation, you have inflation, and inflation at 3% or more, which is what it is right now. We also have unemployment, which you would argue, you can say, is it maximum employment, unemployment, but you would have more unemployment. GDP does not grow. So if you have high inflation, unemployment, and low GDP growth, it is almost like using your butter knife on a rock. Nothing is ever good enough, and the country suffers. That is stagflation. Scenario three is absolutely awful. Scenario three is recession, or what is called hard landing, where we are not able to get out of this rut. The market crashes, unemployment goes through the roof, equities crash, GDP is negative 2 quarters in a row, and hence the recession. America is spending more money, our debt is out of control, but our GDP does not go up. That is an absolute crash and burn. So those are the three scenarios. And I consulted my good buddy Claude, and I started challenging it on, what do you think this probability is going to be? Why is it that? Why can't, Mr. Warsh get more votes? And so I started planning on these three scenarios and their probabilities. And I'm going to share with you where Claude took me. And I did verify a lot of these answers with Gemini as well, and push Gemini, why don't you disagree with this other, point? And I'll tell you how the perfect balance. I wanted a baby bull, instead I got a calf. Dolly needs to get better with this thing. So here is kind of the consensus plot between both Gemini and Claude. The consensus is that Warsh has a minority chance, 25%, 28%, something like that, to be able to cut rates and grow the economy, and somehow the long end does not go crazy. And some of you may say, you got it wrong, that needs to be a much higher number. Some of you may say, are you smoking? 25% is too high. Well, the exact percentage is almost irrelevant. It is the lowest probability case because it's aiming for perfect. Scenario B, unfortunately, the high probability case says that the oil shock is not going to disappear tomorrow. Inflation will be here. Employment numbers will be meh, and GDP is not going to skyrocket. That is a terrible reality, and that appears to be the most possible scenario. In such a scenario, if inflation is high, cost of capital is high. So you have to think about what else that means. Scenario C is a crazy, scary scenario of a terrible, horrible recession, the credit market seizing up. And so these are the three. The only clear winner is A, and I want to wish Chairman Warsh the best and hope he wins, but I'm also going to be a realist here and think about how to plan my portfolio based on these three scenarios. Well, here is what it means. And in the columns, we have the three scenarios. In the rows, we have each of the asset classes. And this is my thesis that I validated with Gemini and Claude. And the graphics are from Claude, but I'm suspecting you should do your own work. But if Warsh is able to wave a magic wand, tech stocks will skyrocket. And we have some tech stocks. I have some tech stocks. These are the momentum stocks that kind of went the other way. However, 75% chance tech stocks will either go down or crash. And that's the reality of the world we are entering. What about defensive stocks? Defensive stocks would be, the consumer staples, pharma, defense stocks, that sort of stuff. They are going to be fine no matter what. And so I started looking at that going, interesting. And so I started buying up a lot more of the industrials and healthcare. I reoriented my portfolio a little bit. I'll share more about what it is. And then you go to dividend stocks. Dividend stocks are where the market rushes. And so in a recessionary environment, for example, waste management, WM, RSG, Republic Services, they both collect trash. You may not go have sushi in a recession, but your trash bags still have to be picked up. So that's the kind of stuff it goes after. And so there is a series of stocks that aim for, an uptick in the event of a hard landing. I picked up a couple of those. But stagflation would be a wonderful thing for dividend stocks because everybody would go towards that. And so the point is, if oil is expensive, stocks that get a royalty from oil would make a lot of money, and that is what the dividend stocks strategy is about. And so, the reality is, if Warsh wins, everything goes up. It's just that dividend stocks would go up by less than tech stocks. And so that is, in general, the stock side. What about the interest rate and how to play that? So if you think of the interest rate curve, the yield curve having a short end and a long end, if the short end is going down, that means anything that has a variable rate will go down. If the long end is going up and you already own long ends, you are going to have a crash. And so I have to think about, how do I allocate it in such a way that I can get above market yields even in the short end. And that is where business development companies, BDCs, come up. And I'll share with you more of a thesis on that in a couple of minutes. But realize that if there is a recession, BDCs go up in smoke as well. My allocation is roughly 2.5%. So I'm not taking huge positions, but I am juicing up my yields with BDCs, because if the short end goes down, I need to make sure that I have some position in the BDC side. JAAA is collateralized loan obligations. This is AAA debt. It gives a pretty decent yield. I'm actually surprised the yield is what it is, 4.8%. And so the interesting thing about CLO and AAA debt is that it is pretty much going to have an upside on most scenarios. And so I've built up 2% of my portfolio into this, and I'm going to keep inching it higher and higher as time goes by, because this seems to win in all cases. Well, let me prove it to you. Well, I'm proving it to myself. You have to prove it to yourself. So I started researching, hey, there is a net asset value for collateralized loan obligations, and then there is a price. Is there an arbitrage between the net asset value and the price? And if so, how much is it? And can I get it, for example, at a discount of 0.1%, not 10%, 0.1%? And the reality is JAAA trades so close to the net asset value that in the entire last month, the best discount I could have gotten was 0.05% of the net asset value. And when that happens, volume shoots up. Everybody and their brother buys it to kind of capitalize on that. So I feel pretty good about buying this. You should do your own homework. And it trades pretty much at par value, and it pays 4.83%, which is 1.2% above what the Treasury pays. So, hey, I'll take it. And so that is JAAA. Then we go on to bonds and what I call the barbell on fixed income. Here, there is the short term, the 3-month one, and the long term, which is the 10-year and plus side. I have a huge portfolio. 55% of my portfolio is on long duration for a specific reason. You can see how when there is a rate cut, long duration is going to go up. When there is a crash in recessions, long durations will go up because agency bonds are backed by the government. Long duration has a positive when there is a recession. It's only stagflation where there is a problem, but if there is stagflation, I'll just hold through it. And so if you kind of look at what happens when this is red, that is green. When this is green, this is green. When this is green, this is red. So this kind of, these two are the two ends of the barbell, as I would call it. And so when you look at my equity portfolio, my fixed income portfolio's duration, you kind of see the barbell. Here is the real short term, and here is the real long term, and I have nothing in between. And so I'm kind of, picking both sides, have my cake and eat it too, I suppose. However, I only do it with world-class credit. So AAA or AA is 45% of my portfolio. The other 36 that says unrated is T-bills. T-bills don't have a credit rating because they're considered cash. And so pretty much anything below an A, I have next to nothing. And that is how I like it. And that is why I'm able to do the barbell. Well, what about muni and agency? What happens when I pit them both? Well, if Warsh has magic, they are both green. If stagflation prevails, then I have the offset. And if there is a recession, I again have an offset. That's why I kind of, do my portfolio the way it is. And there was an article yesterday, I'll post a link on the description. It is called The Real Market in the Long Bonds. It is a shocker. It talks to you about why the second term of the current administration is going to be defined by the long bonds and what happened to it. And so that is why I'm sitting there waiting for the money to come to me. So what are my trades? Well, let me first walk you through my current portfolio. I have 12 or something percent on stocks, as you know. My firepower is sitting in treasuries. I'm waiting for a crash. And if it happens, I will have a lot of cash to deploy. So I have most of that in treasuries, but I am quickly moving them into CLOs, which is securitized debt. And pretty soon, I should have 4 to 5% in CLOs and 30 something percent in securities. Agency bonds are illiquid. I cannot sell them if I want to because the bids have run away for the 15-year and 20-year durations. Same with, my corporate bonds are my duds, but that's only 1% of the portfolio. My muni bonds are also illiquid at 26 something percent, but they give me tax-free revenue. My sector allocation, I have now positioned myself for stagflation and my income through BDCs, another stagflation play on industrials, and I have risked off. I have moved a lot of my tech stocks out of the way to wait for the other scenarios to come to play. I talked about BDCs, and one of our users also said, hey, about those BDCs, which one are you buying? Please remember to do your own research. Let me share what I am doing. And the graphics were created by Claude. The prompts are my own. And so I asked it to present a simple analysis, and I have my conviction on these. These are what I would call the top tier BDCs. They are not the same as private credit. Private credit, the asset value is set by the fund manager. They can come up with a number, nobody knows whether it is real or not. The BDCs, there is an independent auditor. Now, you may argue that's not good enough. There is also an exact publication of financials of the underlying debt, and you get to find out whether they are able to pay their loans back. So you see a lot of, this is called accruals. So non-accruals means X% of their portfolio is not even able to pay off their debt. That's a scary thought. So if they say, hey, we don't have a lot of non-accruals, and this is world-class, TSLX to have nobody on the non-accrual side, that's pretty awesome. And anything under 5% is good, and these three are absolutely fantastic in my opinion. You should do your own work. And then you start looking into, are they first lien? TSLX is first lien. So if the business goes under, if these people come in and do a garage sale, they get their money out first, which I like. And it also matters in terms of, what kind of a market they are in. If this AI thing dies, are they exposed? So that is why I like these three BDCs. And then you have to look at, do they have a lot of leverage? And what's happening to their net asset value? And as you continue on, then you get to the bottom of the barrel. Maine is another one I like. The reason being they don't outsource the management to a third party, and that generally is considered better practice. And their non-accruals are again 1%. And so, for all of these reasons, I really like it. GBDC, I got rid of it already. Blackstone, BCSF, BXSL, these are all a little tough. Sorry, BCSF is Bain Capital. My cut and paste did not work well. BXSL is Blackstone, BCSF is Bain Capital. And so I kind of have a reasonable allocation to them. But what I can tell you is here are the Warsh scenarios. And even if there is a recession, in general, first liens will be okay. And that is why I love the first three. And because they are upmarket, they have a lot of fees that you have to pay to even stay on. And there is some, when interest rates go down, ARCC will have problems because they charge SOFR plus a percentage. But in general, they are better than some of the others. Golub Capital, in my opinion, please do your own work. There is a lot of net asset value erosion. If the AI trade doesn't come through, they are in trouble because they've lent to a lot of software companies. And so this is my thesis, and I generally believe in the first four, and I've allocated my capital to the first four. And so that is where I'm betting my horse. And you do you. So my capital goes to TSLX, ARCC, CSWC, and Maine. I have sold off positions on the others, and for reasons that we discussed before. All of my positions are public domain. I will post the link to my positions, and you can click it and see the positions as of this very episode. Please remember, what I've shared is my experience. It doesn't mean that you are going to get the same results or better results. If you try, you may get worse results. But I would love to learn from you. Share your comments, and thank you for watching Yield Nerd.